Assalamualaikum and a very good afternoon to all, to the chair, Ms. Mongkolo, and co-chair, hope to come, and Ms. Alan Joyce, and all the SME Finance working group members. I also happy to see AFIC colleagues and our honorable speaker, Mr. Kamar Salim from IFC, and all the team members from IFC. So as we all know, SME play a major role in most economies, and particularly in developing countries. This sleeping giant, as my boss always quote them, represent about 90% of the business and more than 50% of employment worldwide. Also, they contribute significantly to GDP and enabler to country export. However, despite of their significant contribution, access to financing is a key constraint to SME growth. It is the second most cited obstacle facing SME to grow their businesses in emerging market and developing countries. Recent credit gap shows that it is estimated to be approximately 5 trillion, and it can balloon up to 8 trillion if we consider the informal sector. Noting to this constraint, policymakers, regulators, and private sectors are putting their heads together to look for the right solution in facilitating the access, thus mitigating the gaps. Today, we are fortunate to have the expert from IFC, Mr. Kamar Salim, to enlighten us on this topic and guide us on how regulators should take supply chain financing as to complement the existing MSME financing landscape. The topic of supply chain financing is becoming an increasingly common vertical within the banking industry. The global credit crisis of 2008 forced trade finance seekers to look for alternatives as liquidity in supply chain became a major concern for businesses. This spurred an increased demand for supply chain financing as businesses work to maintain liquidity and their competitive edge. Before I go further, allow me to give a bit of introduction of our speaker today, Mr. Kamar Salim. Mr. Kamar is the Regional Manager, Advisory Services for Financial Institution Group for Asia and Pacific, and the Global Lead for the SME and Supply Chain Finance practice at the International Finance Corporation, IFC. In this role, Kamar heads IFC Financial Institution Advisory Services, business spanning across nearly 40 countries, covering over 200 financial sector clients, and providing technical support across 10 thematic areas such as MSME, supply chain finance, climate, digital, housing, agri, and gender finance. Prior to joining IFC, Kamar was associated with international organizations like HSBC, Standard Chartered Bank, Deutsche Bank, as well as a large regional bank while serving the several emerging markets. Kamar holds a master's degree in business administration and carries several certifications in areas of strategic business transformation, SME banking, corporate leadership, supply chain finance, credit finance, trade, treasury, sales, banking, and product management. So I think we have come to the agenda. So for today's agenda, I've just gave the welcome and introductions. So after this, I will leave it to Kamal to lead us on the presentation. And about 20 minutes, we're gonna spare for discussion and question and answer. And after that, we have a conclusion and key takeaway. Next. Okay, so just to inform to all members, thank you again for joining. And then if should you have any questions, there's a chat box, question and answer box, as well as chat box for you to share your question along with Kamal's presentation. So in between of the subtopic, Mr. Kamal will stop and then we will collect the questions for him to answer. So over to you, Kamal. Thank you so much.
Thank you so much, Nick. And I'd like to first of all thank AFI for inviting me for this event, and also for your timely intervention as far as the timing of this webinar is concerned. So Without further ado, I want to dive into the topic, and what I'll try to do today for the participants is take them through a journey of three topics. And we'll start with really demystifying what is supply chain finance. We'll go into technologies, how technology is changing the landscape, and then what is on top of most of the participants, so top of the mind is the COVID-19 impact and how is supply chain a solution, a remedy, or a problem. So we'll talk about some of these aspects towards the end. So let me start off by supply chain finance, and this has been growing quite rapidly, but the graph on the right highlights how the supply chain assets have been growing at nearly 5% a year, for the over a decade or so. But interesting to note is the tapped assets are growing at 3 times as much or more. So what it highlights is that the market is waking up to the opportunity, and there's an increased interest and penetration by the financial sector. And these are, a set of banks, NBFIs, technology companies, fintech. So I'll talk about how the penetration has actually taken place. But this is a growing trend, and this is on the left is what supply chain finance is defined as. And till about 3 to 4 years ago, there was no common definition of supply chain finance. And now we have a very standardized common definition that is acknowledged by ICC as well as by SME Supply Chain Finance Forum that you see listed here. So I think it's a growing trend. It's a market to be tapped. And on the next slide, I'll talk about how supply chain is invariably confused with basically supply chain with more reverse factoring. And reverse factoring is called payable finance, is called confirming. It's called different nomenclature in different geographies. But invariably, supply chain finance has historically been synonymous to reverse factoring, which is not the case. And you see on the slide here, there are 8 different core products that we see, 4 of them receivable purchase kind of products and 4 of them loan-based products. In many geographies, asset financing classes such as fleet financing, equipment financing, and more asset financing, asset-backed lending is also a category synonymous to supply chain. So it's not just 1 or 2 products; it's a gambit of products that the institutions need to look at. And in terms of, the question will be asked on the next slide. Let me explain that if this is such a great opportunity and such diverse range of products, why has it not been tapped as much as it should have been? And if you look at the slide here, it's like the iceberg. Typically, institutions are overly focused on funding, capacity support, technology, rate arbitrage. But there are a host of other things that are to be looked at, which are invariably ignored. So in our discussions with many financial institutions and financial sector players, they always complained about scalability of supply chain. Why aren't we able to acquire scale? And these are some of the reasons. Because it's not just about launching products; it's about creating an ecosystem that renders value to the market and to the clients. And in terms of the product usage, on if you can flip slide, let me explain to you where the penetration has been globally so far. So as not a surprise, as you see here, that the payable finance category is basically, and the receivable finance factoring, they're all variants of receivable finance. And if you really combine all that, it's nearly about 70% that is really focused on the receivable kind of categories. But as you go down the ladder, where the finance needed is the most, like pre-shipment finance, like distributive finance, retailer finance, that has not been tapped so far. So I think that's one lesson that the market needs to kind of fall out of love with payable finance and actually go into other categories that are needing finance. And on the right, as you will see, that this is what the requirements from the clients is in terms of the recipients of finance. And one area I'd like to point out, where you see the survey has been conducted over 2 years, and you see the stark increase in the risk appetite area. So the clients are asking for a greater risk appetite, better pricing, working capital finance solutions. And I think that's where many institutions I've seen have launched supply chain programs like a loan, asset backed, or a secured loan, which doesn't really work for the end users. So now transitioning into the SME space, how is it relevant for the SME? And you talked about the 4 point, we estimate 4.7 trillion is the finance gap. I mean, if I look at the entire MSME market globally, it's a $12 trillion market. Of that, the gap is as much as you've highlighted here. There is global SME finance that is available right now and lent out to institutions, SMEs, is somewhere close to 3 trillion. And then there's another 3 odd trillion, 3 to 4 trillion, which is needed in the informal sector. So these are the three sub segments. So this gap that you're seeing is really the formal MSME finance gap that needs to be addressed. And when we did the survey, we did a survey of top 414 SME bankers. These were SME leaders who actually run SME businesses. And these came out as the top issues in SME finance. Credit, no surprise. External environment, technology, which was not there 5 years ago. So the technology, and of course, some of the business related elements listed here. But on the right, I've highlighted how supply chain finance actually mitigates some of that risk. It's perceived to be the global NPL of supply chain program, if we combine all of the programs globally, is less than 0.3%. So you can imagine how risk mitigated this kind of program is. Secondly, on external environment, you work in an ecosystem, you're not working in a single environment. You're connected to large corporates. Technology has really changed the game, and I think that makes the things much more transparent. And of course, on how you engage, it is a low cost of acquisition. It may acquire you, in my own experience as banker, I mean, it will take us, a year to acquire 10,000 clients, but you can acquire 10,000 clients with 2 companies in 1 week. So your cost of acquisition is quite, and that's one of the issues a lot of SME bankers raise, that if I make not more than $300 per client, how can I price my cost, so that, I'm still profitable. So I just wanted to highlight how supply chain actually we see as a key solution. And going into how supply chain should be seen broadly, you can see that many, I sometimes refer to this as, the obsession of the industry, the tier 1 obsession. So you go for tier 1 corporates, you go for tier one banks, and you go for tier 1 anchors. So here, I think the key is that the institution needs to go beyond tier 1. So suppliers of suppliers and suppliers of suppliers of suppliers. How do you go down the value chain? And likewise, on the other side, how do you go down into the retail chain? And we work with a client in Brazil who actually has retailer finance solutions linked to supply chain. It's not purely reverse factoring. And moving forward, I'm coming to the close of the first section, and maybe we can stop and take a few questions at that time. But we've been trying to launch creating markets supply chain initiatives across the world, from Latin America to Africa to Middle East to Asia. And what we have learned in our policy dialogues, financial sector dialogues, rail sector dialogues, is that there are it's a 4-corner model. These 4 have to partner together to be able to make it a success. And I've put regulators on the top in the corner because I think that's where the ecosystem is really defined. And there are some specific areas like secure transaction, collateral registries, bureaus, factoring laws, electronic invoicing, e-signatures, and these may vary per market, but these are some of the areas that are very important to be enabled. And of course, banks need to have a know-how. Technology needs to come in, but technology has its own challenges because they have scalability challenges, they have entry barrier challenges. And then real sector, we cannot forget the large companies in the whole equation. So I think these 4 players have to play together to potentially tap this $1 trillion market. So we feel of the 4.7 trillion gap, Nick, that you highlighted earlier in your comments, we see $1 trillion of it actually lies in supply chain finance. And I think that's where I would like to make a connection, that they're not 2 isolated things, supply chain and SME. They're quite intertwined in many ways. So I think going forward, let me kind of give you some examples as we close off the first section. If you can flip this slide out. So these are some of the regulatory, I talked briefly on the last slide, but in our experience working with regulators in different markets, these are some of the areas that have come up. That is there a true sale mechanism in place? Are payment term laws well defined? Basel requirements, are they honed out for supply chain and actually adapted for that? Conventional lending criteria, you cannot treat a supply chain working capital facility like an overdraft, because you are creating an anomaly into risk reporting and pricing. So I think you need to have different prudential guidelines, asset class classifications. A purchase order finance is not similar to a receivable finance, is not similar to a distributor finance. So those asset class classifications have to be done. And then electronic invoicing. In many countries, accounting laws have to be studied, because sometimes when you don't have the right accounting treatment, this can land up as an asset, as a loan in the real sector company rather than trade debt. So I think we have to be careful on that. And then electronic signatures. In many countries, we were working in Morocco and some other countries, and we realized that electronic signature is necessary for technology to be enabled. And of course, data hosting, cloud hosting versus on-site hosting, those are some of the other issues that have come up in our discussions with regulators. And just to close off, I want to give an example of State Bank of Pakistan. I don't know if anybody from State Bank is on the call, but we worked very closely with State Bank over the last 3 odd years. And it's a great example of how a regulator stepped in to enable supply chain finance in the country. And these are some of the stuff I've divided into 4 pillars, from knowledge creation to creating demonstration effect, to creating guidelines, to creating product innovation. So we all started with doing workshops with the central bank and the financial sector players. Diagnostics were conducted, knowledge guide was launched together with, so having a common understanding of what supply chain is. We also did some sector mapping exercises alongside looking at a few sectors, looking at the physical, financial, as well as information value chains. Then we transitioned into doing some work with 3 of the banks, UBL as the second largest bank, private bank in Pakistan, Mizan, largest Islamic bank, Al-Falah, 5th largest bank. Some large banks in the country, actually, we are advising as IFC. And then regulator guidelines were launched by State Bank in 2018. And most recently, they've actually established a supply chain forum, which is consistent of different stakeholders. And they are planning to give even supply chain targets to banks. So I think they've transitioned from knowing the product to actually giving guidelines, to actually setting frameworks, and to giving targets. And product innovation is now in the play. We have, through the engagements with these banks, launched about 8 to 10 different products in the country. And of course, it's not the problem is not solved, but I think they are on a very good path. So that's it. And I'll close off. I'll just want to highlight that it's not just corporate value chains. I think we should also look at agri value chains, and it's not purely linked to corporate value chains. So on the next slide, you will see the nature of value chain interventions. This is another example of Morocco. I will not go into it. You will see the same 4 pillars that we have enabled in the country. We are at more initial stages in Morocco, but we've had these dialogues. So this is another thing I wanted to highlight, that supply chain is not purely corporate value chains. It also is agri value chains. But the players and the nature of financing is quite different. And you see here, from input producers to farm operations to post-harvest, processors, distributors, retailers. So there are different solutions needed. And we worked with banks, and one example is listed here, Bank of Langfang, that we worked in China on helping them tap the agri value chain. So that's another area that needs to be looked at. So in summary, let me kind of finish off on the first section. It's a growing market. It's highly related to SME finance. It is an enabler that can solve the SME finance problem. And it has many variants to it. It's not just reverse factoring. I think we need to look at it broadly. And I think there are regulatory interventions are quite important especially role of central banks, I've seen has become very important in this. So I'll pause here. I don't know, Nick, if you'd like to pause here for
Yeah.
questions, or should we
Yes,
continue?
I think, thank you so much, Kamar. So basically, we received two questions. So basically, the one that you mentioned just now in a nutshell is that, it's another options for the type of financing for MSME. And then you did mention that, it's not only for corporate, and it's also, something that it's very close to our member, which is on agriculture. The two questions that I have here is, okay, the first one is, what policy infrastructure or environment needed for supply chain financing? And second question, because you did mention about putting all these private and public sector together, the question is how regulators may bring together the table of these four types of stakeholders: regulators, bank, fintech, and real sector, to make sure that the supply chain financing happen. And if you can share any successful example out of the members that you have conducted before. And then the third questions, why there is many regulators wondering about using the e-signature, and do you think that the QR and blockchain as a solution to that? Because we have a new fintech and also blockchain as to replace the e-signature. So we have three questions first. Maybe Kamar?
Okay, great. These are three fantastic questions. So let me briefly cover each one of them, and of course I can share more details if members need at a later stage. So in terms of policy infrastructure, I think there are 3-4 elements that are needed. I think one is information sources. So bureau information, data availability. Do we have a pool of infrastructure where you can have reliable data? So I think that's one, and bureaus and all these information sources are even technology platforms. Is there a central electronic signature like Turkey has? This infrastructure of e-invoicing. So do we have this central infrastructure of capturing the invoices and generating data out of it? I think that's one. Secondly, do you have mechanisms in terms of registering your claims against the intangible assets? So, for example, secure transactions regimes, having insolvency laws, having laws where you can actually claim a receivable against an assigned invoice. So do you have registries where these can be registered? So I think that's another second ecosystem that is needed in terms of the third is more around the central bank guidelines on how these asset classes are being treated. So I mentioned in the 6 points. So those areas, from technology, from electronic signature, to having all the factoring laws. So having all that infrastructure from a central bank standpoint, and then of course laws and legislation, which is factoring laws and other laws, for sale laws, even payable laws. I mean, corporates, can they delay indefinitely the receivable payments? So are there even laws to govern so the payments are made in time? And UK has done something like that very effectively. For example, putting caps on how much delays can happen in payments. So these are some policy. I think it may not be exhaustive. From the top of my mind, these are the things I can think of. So second question on the forum, and I'll again go back to the Central Bank of Pakistan example, where they have brought in the key banks, the key players, advisors like us, and institutions which are SME focused like SMEDA and others. So having that forum, which is consisting of the 4-corner model, and creating a forum of interaction. I think that's really one. And there are other countries like I've seen where industry associations have created such platforms. So you bring in industry associations, you bring in. So I don't have a slide here, but there's a slide I usually present, which is the entire ecosystem, where you have the banks, NBFIs, MFIs, fintechs as financial institutions. You have policy ministries and the governed policies, then central banks and the financial sector. So how do you create that forum for interaction? I think that will enable a dialogue to address some of the key topics. And And the last question on blockchain and new technologies, I agree, blockchain is definitely the new kid on the block. It is definitely catching fire. The only thing is it's not tested to the extent it needs to be tested. So there are only few, I mean, Stanchart has launched with Burstline. Some of the institutions, some of the large sophisticated banks have gone with supply chain, blockchain-based solutions. And I'll cover part of that as we go forward because that's the next topic. So I'll
Yeah,
maybe not go too much into detail on that.
yeah,
But yes, I do see there are AI, blockchain, machine learning, robotics. That is the next frontier in
yeah,
supply chain finance. And it's really coming to it very soon. So I'll
yeah.
pause here.
Yeah, because one of the members also did mention that, and about the support for product innovation, can you also give any example that could implement, this kind of like SCF, but through fintech, but using the sandbox? Meaning that, if you want to have like this SCF, but leveraging on blockchain or fintech, but is it going to be like through the same kind of process for the sandbox process, or how does it go?
See, industry sandboxes on supply chain are not as prevalent as some of the other SME lending and retail lending that have come into play globally. But I mean, I can give an example of it's not really a sandbox, but a central institution where a technology enables supply chain. And an example of that is NEFIN in Mexico. I think that's a development finance institution that has the technology, that has close to 600 companies registered on it. There are millions of SMEs gaining finance in a central operating environment. I think that's one kind of example where an development bank has come forward. Another example is multi-bank platforms where likes of Prime Revenues and GT Nexus and others, who go into markets and actually have a multi-bank environment where many corporates and many SMEs can play together. I think that's the second example. But there are fintechs, that offer like there's a fintech in Indonesia called Bakulapa, which is doing MSME finance to mom and pop shops. But that's a very specific technology solution for a specific segment, geographies, and all that. So that's an example of a fintech really going into one specific territory of a supply chain finance. So there are examples, but as I said, this is not a segment that has been championed yet. I think people are doing different things right now, and I think it's coming of age. Sandboxes. I mean, we have pioneered in Singapore sandbox, which is called Affin. It's a brand name Apex. And what that does is it connects fintechs and banks. So that's the only sandbox environment that but many of the institutions are creating their own sandboxes. But I think that's one example, but it's new, and we are co-investors in that.
Okay.
But I think that's another example of how you can
Sure.
enable that.
I think we can proceed first, and then we can keep some of the questions as part of the later part. Proceed, Kamar.
Okay, well, thanks. So I'll briefly touch upon, I think we talked about technology a bit already, and I can see that's on the top of mind of most of the participants. But let me highlight to you how technology is not purely technology platforms, but fintechs also coming in. And you can see that the fintechs share in supply chain finance has grown from 5% to 15%, and it's projected to go to about 25% over the next 5 to 8 years. So you can see how fintechs are rapidly entering the segment. The only caveat is that they are mostly in developed markets, as you see, in large markets as of now, where the growth has happened. But in our interactions in many developing markets, emerging markets, we see now almost in every country that recently I've been to, whether it's Indonesia, whether it's Pakistan, whether it's Bangladesh. I was recently in Bangladesh, and there's an institution launching a blockchain-based supply chain finance. So I think it is rapidly coming in terms of fintech interventions into supply chain finance. So that's a space to watch. As we speak, there's a fintech in supply chain born every day. So that's the pace of supply chain fintechs happening globally. So I think that's a trend to watch. And the only thing I'll highlight is fintechs are not trying to do everything in supply chain. Somebody will do payable finance, somebody will do distributor finance, somebody will do mom and pop shop finance. So there are tapping like fintechs have done in the banking sector. They are tapping subsegments of supply chain finance. That's one. And on the next slide, I'll talk more about what are these platforms, because fintechs is one, but there are, and I do separate the platforms from fintechs because fintechs lend as well. These platforms are more intermediary platforms. And these platforms have been, are categorized into three. Many financial institutions were in the habit of building their own platform. And I've spoken to many large institutions, and historically that was the trend. But they've realized that the pace of the change and the cost of building and the time to market is very challenging internally. It can take you up to $2 million to build an internal platform, and then another $500,000 a year to maintain it. So that's the cost of internal. But when you go to other solutions, a software as a service solution or a licensed platform is what is now a more I think rapidly growing trend, and more so in the middle as a software as a service is where we see many more institutions alluding towards. But there are cases where banks or institutions would like to own a platform, then they go for license. But I think at the back end of it, it could be a platform which is a third-party platform. So these are the three. I will not go through the strengths and weaknesses. I think this document, I believe you'll share with the participants, but I think these are some of the areas. Now, I don't want to restrict ourselves, and a point was made earlier by one of the participants, which I fully agree. It's not purely about technology and fintechs. There are many aspects to it, and I've bucketed them in these four categories. One is digital infrastructure in terms of connectivity, payments, and electronic invoicing. Electronic invoicing, I think, is a game changer. If you are able to bring electronic invoicing in your country, it has both taxation benefits, it has transparency benefits, it has data benefits, it has accessibility benefits. It has a lot of benefits, and I think there are global conferences being held on electronic invoicing at this time. So I think that's one. So digital infrastructure is one, and it kind of is alluding towards one of the questions your participants asked as well on what is the infrastructure needed beyond conventional infrastructure. So this is the newer infrastructure. Then I think we talk about these interfaces in terms of APIs and distributed data management. That's where blockchain is coming in, and also in terms of verification. How do you verify the identities in the process? I think that's the second bucket. The third is around managed services. The platforms, I've already talked about this. I will not harp any further on it. And fourth is on analytics, and data is king here. I think if you are able to, a lot of these technology platforms, when you talk to them, the real product they're getting is data, because they have this data which can be where you can build algorithms around it, you can build scorecards around it, and all of a sudden you have lending models which never existed before. So these are the four areas. We are about to launch a supply chain in technology knowledge guide. IFC has been working on it. We are at the final stages. I'm the co-author of that. So you will see that in the next couple of months launched, and this is an extract from that. And just lastly on technology, I think since blockchain was raised earlier, how is blockchain changing the game? And these are some of the attributes, how it supports the credit decisioning. I think one is that the credit score is not generated by one party, but by multiple parties. So I think it's a much more robust scorecard. Secondly, the credit profile is much more reliable because the data cannot be played with. It cannot be tampered with. So it's already coded. So in that way, it's secure. So how you share and who you share, you can decide. I think that's another advantage of that. You can tokenize it and transact it, which is not the case in many technology platforms. And then you can even have the scorecard expiry date. So the scorecards can be returned at certain points in time that you decide, and then incorporate that into smart contracts. And then scoring agencies. I think that is another area that how scoring agencies can actually come into that and strengthen your information models. And lastly, the history is traceable. I think you can actually go into the chain and trace the whole history. So I'll stop here. I think this is where, Tati, I don't know if you have any more slides on technology, but I think this was
I
the last
think we
one.
have,
Yeah.
this is the
So if you can
yep.
flip back here. So I'll pause here. I think this is a new area. Technology platforms is relatively more mature. Blockchain and neo technologies a bit more nascent. I'll
Yeah.
pause here.
Yeah, I have questions from myself. Come on, you did mention about this platform, and then this platform is, different than having a pure kind of like, fintech intervention, because some of the platform is a plain vanilla platform where they only the intermediaries, but also there are some platform also that offer credit. So in the event that, they offer credit, first, the protection of data is a question. Second, how do we make sure that this platform is is a legitimate platform where when people put their money or people do the credit through this platform, and then they can rely on this platform? Who's supposed to safeguard this regulation? And then the second question would be like when you mentioned about the digital innovation, the fourth step require a lot of infrastructure interventions. So considering that developing and emerging countries, do you think that by having new fintech we could surpass some of the processes, and then go through a simpler mode of through using technology? And the third questions regarding the credit scoring, when you mention about credit scoring and tokenizations, does it also reflect to the original supply chains modality where you have the supply led and also buyers led transaction? Thank you.
Okay. So thanks. It's quite a loaded question. So let me try and unbundle it a bit. So I think first on let me talk about some of the data privacy and how this technology protects the interest of different parties. I think that was your first question.
Yes.
And that's the reason that the supply chain technology providers who are also financiers are not as many, because it's an entirely different ballgame when you are lending out, because you have capital requirements, you have you have licensing needs, so there are much more complexity. So hence bulk of the technology platforms that you see globally right now are purely intermediaries, and once they play that intermediary role, there is watertight uh, legal agreements, tri-party agreements signed between, and that's why it's usually more of a buyer-led models where you can be talking to a Nestle and you work with Nestle and a bank and and a few SMEs. So actually you sign agreements in terms of disclosures, all these legal terms. And we were advising a bank in Lebanon, and there was never a agreement done in French in that country. So how do you actually which laws does it abide by? Is it local laws? It is it is the English law? Is it a French law? So I think there are different connotations to how the interest is protected. But all I can say is in all the programs, there are very, very concrete examples of agreements, and the rights are protected in such cases. And when they are doing financing, and I give NAFIN as an example, there are again examples of how the whole onboarding is actually done under an agreement, and the rights of all the parties are protected. So there are examples. I don't think if it was not well managed, I think we would have had many frauds and many issues in supply chain space globally, and that's the reason it's not happened. I think that's one. On scoring models, if I understand your question, is does it replace some of the existing infrastructures, or I
Yeah.
didn't fully, yeah. So I think scoring models are a supplement to what a bank can assess, because at the end of the day, the scoring models, whether they are generated through scorecard engines of these institutions or generated through data interoperability, through acquiring these through multiple platforms, the scorecards are in the end basically leveraging the cash flow data, where you don't have to rely on obligor data. I think that's where it's different. and it's dynamic because, for example, those scorecards in a COVID-19 environment are no longer valid. So I think you have to make sure to take those scorecards with a pinch of salt on how relevant are they in different regimes, and they have to be sector based. You cannot apply a scorecard for a garment sector to an engineering sector, for example. So I think industry focus, and I like to emphasize again and again, industry focus on supply chain. Unless you champion an industry, unless you fully understand, and we worked with the banks like Santander and some of the large banks who actually champion supply chain programs. I mean, they have industry specific teams on supply chains. It's not just launching supply chain product. So I think, I would say credit scoring models, but they're very powerful. And now they're going into AI and predictive models on supply chain. So there are newer models coming up, but this is a relatively new space. And your third question was around digital infrastructure, right?
Because it requires a lot of intervention in terms of infra.
Yeah. So I think it depends on what you mean by that, because you can have a digital infrastructure at a market level. That is far more complex because there are multiple stakeholders involved, but digital infrastructure can be created at an institutional level. And that's what many of the developing markets have progressed to, because it is not possible to launch market-based technology platform in a very short time. But a bank like, we were working with UBL, and that bank went with a certain technology providers, adapted the needs to their requirements, addressed some of the issues that were there in terms of regulations. And in that way, it's more of a bottom-up approach. You don't have to have a market platform. And there are not many examples of marketplace platforms, I can tell you, because the interest, many of the times, these institutions compete for market share. And it's very hard to have multi-bank platforms. So that's why we've seen both approaches, bottom-up approach, top-down approach, less relevant. But I feel top-down approach is much more impactful. And that's where the role of regulators and the institutions is very important, to bring in platforms that are market-based, that the whole market can benefit from. It could be a sandbox environment, could be a marketplace, could be different type of engines. Marketplaces are coming up now. I think that's another area where you can actually trade the supply chain instruments. So there are new areas coming out, but I agree with you that this is an area that needs work. But all I'll say is we are working in the very developing markets. We worked in Kenya, we worked in Morocco, we worked in Yemen, we worked, many of the very difficult markets, and it's not a deal breaker that we have to have everything in place for us to go. Somebody has to go and create a market.
Yeah, at least we start first, and then others becomes after that. Absolutely. Okay. So we have one question from CBJ, Central Bank of Jordan. One of the main challenges for those new technologies to enter developing economies is the culture readiness. So culture readiness, how we can make sure SME use it, of the competent MSME to use it, how we can overcome these challenges, and what is the regulator's role. So it's all about culture, and then how to embed those culture into MSME, and what is the role of regulator.
Yeah, no, I'm glad to hear a question from Central Bank of Jordan. I've lived in Jordan earlier, and we've advised a couple of banks in Jordan on supply chain finance. And let me give a Jordan example, because we were working with a bank and we realized that the SMEs are very used to getting checks. And as soon as you move them away from having electronic exchange, it was a big cultural shift. So they were not willing, and then there were guarantees exchanged between corporates and SMEs on trade, and those guarantees will no longer will be there. So all of a sudden there was a lot of uneasiness on how. And if you don't have a technology-based solution, you've kind of killed half of the proposition. So I think from that standpoint, I think there are 2-3 things will need to be done. I think where regulator can come in is to educate, because many of these institutions, SMEs, even the large companies, you'll be surprised to know that in many countries, I've realized the capacity building is not just needed for the SMEs. Capacity building is needed for the large companies also, because they don't understand how to manage this. So I think that's where a lot of knowledge development can help. And secondly, in terms of creating these forums, like I gave the Pakistan example, creating these forums of information exchange where different parties can exchange notes and as well. The third thing I'd like to highlight is the whole onboarding process, because you cannot typically a lot of these technology providers have an online onboarding process. It's all online. And many of these SMEs, and we realized in Jordan, we saw it in Lebanon, we saw it in Egypt. Many of these SMEs are not willing to purely onboard and share all their data and information online. So you have to have a bit of a high touch onboarding rather than just a light touch online onboarding. And then you may have to phase this out. You may go into one sector rather than going after the entire market. And for example, in Jordan, one of the sectors that was looked at was pharmacies. There were a lot of pharmacies and medical sector. How we can stimulate that as a segment rather than going at the entire market. Then you work with a certain industry association, industry players, and actually stimulate in one segment and then expand it to the market. So this is briefly. I'm also conscious of the time, so I'll briefly touch upon that. But I can share more examples of Colombia, Mexico, Dominican Republic. We work in Indonesia these days. So I think similar practices, we are seeing cultural issues, yes, play a big role, and they have to be managed.
Okay, another question, quick one from Luis Jose from CNBV Mexico. So the question is, are money laundering policies is an opportunity or a limit for blockchain or new technology?
Yeah, I think AML blockchain is increasingly being used for AML, CFT, and we've really seen a recent advent in this. It's not really well tested so far. All I can say is it's relatively new. Blockchain, I like the idea of the distributed ledger, but I always am cautious on how much it has been tested and how the engines are foolproof. So I think it's a new area to watch, but I don't think it's been championed yet.
Okay, so I think we can proceed first on COVID-19, and then we can take some of the question later. Proceed, Kamal.
Sure, thank you. So I know a lot of people must have COVID-19 on their mind, and that's why I wanted to make sure I make relevance of this topic to COVID-19. So flipping the slide, we somehow lost the PowerPoint, Nick.
Yes. Okay. Is Tati there? Okay, I think we are back. Okay.
Okay. So as the COVID-19 appeared, the slides disappeared.
What an ironic. Okay.
Yeah. Anyway, so let me quickly talk about the COVID-19 on the next slide. I just want to set the context that this is
next slide, please, Tati.
So this is not an issue of a small magnitude. I just want to highlight that it's anticipated. The growth slowdown is going to cost the global economy about $4.1 trillion. In a global economy of close to 100 trillion, that's definitely a sizable. And just making a comparison to SME, a finance cap, you can see how big this impact is. And from a timeline perspective, I think we have to be also cautious. These are estimates. Again, we don't prescribe to any of these. These are quotes we've made from different researchers. But all I'm saying is it's a longer term revival. It's not in short. These things are going to reverse. And these are on the right side when it comes to supply chains. And these are some of the sectors that are going to be more impacted than the others. And you're already seeing impact in the top two quite heavily, as well as the third one. But as you go down into automotive, apparel, fashion, global value chains, we are seeing the impact on value chains of the SMEs is far more. Now, what that means, if you can flip the slide, is that what are the issues SMEs are facing? And I'll try to be quick in some following slides because I want to share with you some China experience at the end, what we've learned from there. But I think these are some of the issues in terms of demand disruption, falling sales, exports, access to imports, which is not easily available. So I think all of us know what the issues are SMEs facing. And I do feel when it comes to supply chain, there's a role for corporates. That's not enough to be left to regulators and financial sector to come in. The corporates have to, ease their payment terms. They have to play the role of an advisor to their value chains, segment them, support them in the ways they need to be supported. So there is a role for a value chain player, which is the large corporates, and that will immensely benefit the SME. So that's one area, how a large corporate can come in and support some of the issues listed on the left. And on the following slide, what I'd like to highlight also is what are some of the financial sector interventions can be made in terms of short-term support, in terms of grants, guarantees, concessional lending, trade finance, and we as IFC are also launching trade finance, the COVID-19 response. Then also in terms of bank lending, factoring, tax credits, and I'll give some examples of some countries who've already done some of these things. So these are some of the financial sector solutions that can be enabled through partnership of private and public sector in different markets. And on the next slide, you will see, Tati, if you can flip the slide.
Next slide, Tati.
Yeah, so these are a summary. We've studied many different interventions being made by regulators at this point in time, and this is like a summary of many of them, how central banks are responding in terms of policy cuts, liquidity injections, subsidized facilities, tax reliefs, the specific disaster relief programs, the direct financing support programs being launched, procurement payment delays, are being instituted so that, the payments are eased off in terms of cash flows. Commercial banks are looking to launch packages, and you see an example on the right where it's a Swiss SME. It's an instant loan. Within 30 minutes, you can actually get a loan in a COVID-19 small business loan. And we are seeing more of these coming in many other geographies. This is just one example I picked up top of my head. And on the next slide, you'll also see an example of Turkey. This has been recently launched in terms of their financial sector response package. And it's divided into three categories: loans, tourism, and employment. And you see some of the ideas I mentioned in previous slides in terms of deferred payments, in terms of working capital inventory management, credit guarantee funds, force majeure, scores, how they are LTVs, enhancing the LTVs that you can get. These are actual reform package already announced recently, end of March, by Turkey. And then tourism packages, as you know, Turkey relies heavily on tourism. So there's some benefits on that, and then on employment, on tax payments, on basically minimum wage support. So, I mean, I will not go through all of them. All I'll say is this is one example of all of the ideas I was mentioning earlier that many countries are launching. This is one actual example of a country that has recently launched. By no means I'm saying this is the best response or the worst response. All I'm saying is this is an example of institutions, financial sector responses that are coming through, and the country responses to the economic crisis. And I think just going forward in terms of the response, how this response needs to be looked at, if you can flip the slide, you can see that there are some key elements that need to be considered when you launch these response plans. I think one, and the two fundamental elements that we have seen is transparency and time bound. I think you cannot have a policy, and like you saw in Turkey example, for 3 months, for 2 months, for 1 year. So they very specific time bound measures and specific measures. And tools, fintechs, I think, have become far more relevant than they were earlier. And I'll talk about China in a bit, where we saw that public procurement can play a role at this point in time to stimulate the falling demand that SMEs are facing. And also some of the regulatory reforms that I mentioned earlier, some examples in terms of bankruptcy laws, debt enforcement, collection enforcements, the treatment of their overdues and all that stuff. So I think those can be considered as a policy response to the financial sector, by the financial sector for the SMEs. And going forward, I think the other thing we need to look at is response needs to be seen in two phases. You cannot really look at a response as a holistic response. There has to be a short term, like a 6-month plan, and maybe a longer term plan. So what do you do to handle the outbreak, and what do you do to handle recovery? So I think that's the two phases of intervention that will be needed. And just I want to finish off because I'm conscious we have 5 to 10 minutes left. So I will finish off with some examples. If you can move forward, Hadi. So this is an example of China, and you know, China, as we all know, went through this process, and we are in the process of sharing. We've organized close to 10 different webinars sharing China experience with many of our clients and partner clients. So this we had done alongside a few institutions in China, a survey of 2,000 SMEs in China and understanding what was the impact. So this was, I'll elaborate some of these on the next slide, but overall, no, I think if you, Tati, if you can stay on this slide, I want to kind of, previous slide. So I think there are 5 themes that emerge. Or let me just talk to this slide. So the first is the confidence outlook. The SMEs initially had thought that the impact will be far worse than it was actually the case. So there is a positive outlook in terms of recovery. So that's one that finding we didn't expect. So that's one. Secondly, in terms of financing needs, so they feel the 70% felt the need will be even greater post in the recovery period. It's not enough to support during the outbreak period. Thirdly, wherever the institutions had online businesses, they had far more advantages in terms of, you know, the ones that did not. So, and 10% of them actually increased their profits. So you can see how digitization and online businesses were fared far more better. And in terms of access to finance, the businesses that were more digitized in their own operations were, I mean, were twice as better to get financing from banks than the ones which had not digitized. And I'm talking about not financial digitization, but digitization of their own operations. So where SMEs were digitized, they were able to get access far more easier. And in terms of regulation, interesting thing was that the fiscal policies were considered far more effective than the financial policies. So in summary, if we can flip back to the last slide, Tati, I think these were
last
the 5.
Slide?
No, not the previous slide.
Yeah, previous slide.
Yeah.
Okay.
So this is a summary of, you know, what we learned. So just a summary of the last slide. So online operations, advantages, business digitization, higher access to finance, fiscal policies played a bigger role, SME confidence, that is the SME confidence to return back to normality was not as devastating as they had expected, and good financial behaviors, good financial discipline that SMEs were maintaining were able to secure a better financial health. And as you know, they are on a road to recovery. I would not say they've recovered, but this was some valuable lessons learned by surveying about 2,000 SMEs in China. So I think that's it. I'll conclude the discussion by just 3 points. Supply chain, I think, is a promising trend. It's actually a solution to many of the problems that are being faced right now. It's a growing trend. There are growing technologies and, you know, solutions available. So that's one. Secondly, technologies. I think the journey has just begun. There are many technologies coming through into the supply chain. So that's a trend to watch. Newer solutions. And lastly, COVID-19. In a COVID-19 environment, while global value chains are massively impacted, there is opportunity in domestic value chains and seeing how they can be leveraged and how SMEs can be supported through supply chain solutions, because giving a pure vanilla overdraft in this environment is not feasible, but giving a supply chain line of credit with partnership with a large company which has a strong credit background is far more risk mitigated than plain vanilla SME finance. So I'll pause here, and I really thank you, Nick, and
Thank you
for this, and if there are any further questions.
Thank you so much, Kamar. So I think you really wrap up the three main things about SCF, like, enlighten us on the overarching and the function of SCF and how it could complement the existing financing landscape for MSME. And the second part that you mentioned about by leveraging on fintech and also blockchain, we could, the role of SCF could encourage better, and also how SCF could help in the events of COVID-19. So we still have questions regarding on the fintech thing. So this question is coming from CBJ again. Uh, Central bank issue hundreds of measures for SME affected by COVID-19. What is your recommendation specifically for supply chain financing for MSME? That what is your recommendation also for micro enterprises, that some of them usually join the supply chain financing cycle in deliver the product or raw material in between parties? So how's supply chain in the process of when this pandemic happens could help the MSME? So that is the first question. So the second question is, one of the major concerns brought by COVID-19 is a break or crash of global supply chain. How regulators may help to prevent it or to restore it later? And the last question, SME aggregators platform now booming in the Middle East. Do you think that those platforms will have a positive impact to promote SCF? Over to you, Kamar.
Okay. I mean, these are fantastic questions. Once again, Nick, I think you have a fantastic, list of people joining. So let me start by response. I mean, that's really a very big question, and I'm not sure whether we have all the answers. I wish I had a crystal ball on what can be done. But I think there are two, three things when it comes to micro enterprises are affected differently to SMEs, in many ways, because that means the models in SME micro lending are more akin to group lending, and SME is more akin to individual lending. So I think they are impacted a bit differently, and not all the micros actually land up in a value chain. So we have not seen many microfinance institutions very closely linked to value chains. So I think we need to also be cautious on. I feel supply chain has a bigger linkage to the SME space than the micro, and I think that's where it can stimulate far more access. How the regulator can help is, one, through hastening some of the policy measures that need to be taken. So if there is an electronic signature impeding, or if there is any specific regulatory enablement needed, from a factoring law or anything, any legislation that is already in the works, if you can hasten launch of that, I think that's one. Secondly, in terms of engaging stakeholders, I think stakeholders on supply chain are not SMEs directly. You have to go to industry associations, you have to go to different large companies. So where a regulator can engage more on a broader scale, the stakeholders, and bring them all on a table, I think this is the time to bring them all together on a table. So I think that's the second area that can be enabled. And of course, product enablement. I think that's the third thing, because many of the products, like a true sale, understanding what that true sale means, understanding how you should treat overdraft different to receivable finance in terms of for sale value and LTVs and others. Can you hasten your prudential regulations around your asset class treatments on supply chain products? And fourthly, around guarantee schemes. And many, like I know in Jordan, they have JLGC, Jordan Loan Guarantee Corporation, and many countries have credit guarantee corporations. I think there is a need for guarantee corporations to step in and actually offer some, risk mitigation products, which are not purely linked to value chain, but could be distributor linked, could be purchase order finance, could be the higher class risk categories where the need is the most. Once the SME needs to manufacture or to make something, once he's delivered something, the receivable period is 10 days, 14 days, 30 days, or 90 days. So, I mean, can you go down the value chain? So these are some of the areas briefly I'll mention. Then I think the global value chains, how they are being disrupted. Now, interestingly, we've seen in the recent past, the intra-regional trade has been growing at 4 times the pace of global trade. So I think that's one of the areas. So there's a lot of regional trade going on. I think that's a trend to watch. I'm not trying to undermine the impact global value chains have. And we recently did a study, and I can share with you, Nick, and you can share with your participants on how global value chains will impact SMEs. But as you will see that the SMEs in many ways are not tier one in the global value chains. They're either tier two or tier three. So you cannot purely look at SME in a value chain. You have to look at the intermediaries that are coming in between. But I specifically the import and export reliant SMEs are going to be far more impacted than a retail shop in the corner who had to close for 30 days. I think we have to also distinguish which are the SMEs, which are international prone, and which are not. So domestic demand driven will be treated differently. And the third on SME aggregators, if I understand correctly, these are more marketplaces and people, technology companies offering financing solutions. I believe that is being referred to. So SME aggregators are rapidly growing. I fully agree. I think they are heavily relying on data, but there are many that are not in a stable state. So I will take it with a bit of caution in this new environment. A lot of the credit models they've used have never been tested in a downturn. And my concern will be, yes, they will be impactful, but we need to watch that they don't distort the market, because the historic credit models, they are purely reliant on data, purely reliant on alternate data. Some even rely on purely on social media data, on Facebook data and other things. I just feel a lot of predicted models that were in the past are not relevant anymore. They are relevant, they are important. We are also seeing marketplaces come up, like Base to Credit in the USA, which combines all the financial institutions giving to SMEs, and SMEs can go and pick and choose. So that's the marketplaces are also opening up. We are seeing in China, Ant Financial and others have launched these marketplaces. So I think these marketplaces are becoming much more prevalent. E-commerce players are becoming far more prevalent. But I will close on one thing. There's a lot of talk about fintechs and SME, but if I really look at all of the finance done by globally by all the fintechs in the SME finance that is being done, it doesn't exceed 5% of the SME finance done globally, even now. So they are definitely a stimulant. I don't see them as an immediate solution. They are definitely an enabler, and it'll take some time for these to build and for them to rethink their business models to stay relevant going forward.
Interesting. So yeah, I mean that you were rightly mentioned that we have a lot of other alternative kind of like scoring and data, but some of them, as you rightly mentioned, has not been tested. So those are the things that we need to a bit cautious in applying those new model to make sure there's no macro effect to it. So we're still running on the questions now, and then another questions is on the what JLGC, because you mentioned about the Jordan guarantee company. What JLCC guarantee corporation criteria should be relaxed nowadays to cope with the impact of COVID-19 and to support HCF for MSME. So, I mean that, in terms of like the criteria, what are the things that should be relaxed in the event of COVID-19?
See, I don't think I'm in a position to give a clear answer, because I think they would know better. But I think that some of the things that we are seeing happening elsewhere, I can just mention, like there's a credit guarantee fund being launched by Turkey, credit guarantee scheme. I think that is one. In terms of your LTVs, can you have higher LTVs? Can you have some specific loan packages in terms of COVID-19 environment? Can you have faster loan portfolio approach rather than an individual loan process? Can you launch a portfolio product for that with faster decision-making processes? Can you adapt some of the products that are already? We worked with the LGC, and that's why I'm a bit cautious on giving any specific recommendations, because we know them very well. So I think there are specific examples of how credit guarantee schemes are responding in Egypt, in Turkey, and I can share that with you, Nick, in terms of
Sure.
what those examples are. But I think if I was to summarize, I think one is on the product. I think that's where you need more robust products. Secondly, you need more relaxed terms in terms of tenor, in terms of pricing, and also in terms of LTVs. I think that's the second one. In terms of underwriting capabilities, you need to have portfolio approach rather than individual approach in underwriting. And then I think you need to have some softer terms on moratoriums are typically dangerous, but still I think you will need to give some kind of short-term moratoriums on this new product line. So I think the product line they have will need to be thought through and adapted as well. That's the last point. So that'll pause here.
Yeah. It's very interesting when you mentioned the last sentence that you mentioned about moratorium. It's, it's kind of like quite dangerous in the sense that, most of our central bankers and also regulators are taking currently during this COVID-19. So why is it like, if you can, explain further on that?
Yeah, I think I'm not saying I'm fundamentally against it. I think in many cases it is necessary, but nevertheless, I think it has to be time bound and it has to be well managed. The issue is that you don't want, like I mentioned earlier, to a liquidity crisis to become a financial crisis. So you need to have some very structured methodology on what moratorium, who gets it, which sector gets it, which sector doesn't get it. Rather than just going plain vanilla, okay, all SMEs. I just feel that's a bit dangerous. I think it's inevitable in many circumstances right now. I'm not against, and many regulators are doing it, and institutions are doing it. But all I'm saying is do it with a bit of caution, make it time bound, make it transparent, and make it very specific to the segments that you want to support.
I think I totally agree with you because, it all boils down to the macro effect that, if you let it loose or make it like an open blanket. So as you rightly mentioned, time bound and targeted sector is very vital and necessary. Yeah, I think we don't have any more questions coming from participant, but I do have questions on the COVID-19. So the COVID-19 questions from my side is that you mentioned about this China experience. Over 2,000 MSME collected the survey. So those five principles that you mentioned, to some extent, it's like a standard that we could apply to other member countries also. But in some instances that, because in China, they are a bit robust when it comes to online platform or online transaction as compared to other countries. So do you think that, other four or other three resonate the same kind of like principle that happened to other member institutions when it comes to COVID-19?
I fully agree with you. I don't think we can generalize. China experience is a very, very developed market, very robust technology and data regimes. So that cannot be generalized. And that's what we are right now. We are in the process of conducting SME surveys in about 8 different markets because Bangladesh SMEs are very different. SMEs in Kenya are very different, So I don't think it'll be the same, but some of the areas in terms of like financial discipline. I think any company having a better financial discipline will do better anywhere, whether it's Bangladesh or Kenya or anywhere. And maybe digitization is sometimes wrongly used. The businesses that have purely automated their accounting, they have a system to manage their own value chain. Some simple technology, even basic technologies to manage their own business. That is there in all geographies, So the businesses that manage their own business much more proactively rather than a paper-based management, I think they will do better in any of the geographies. That's the second category. The ones that are in specific sectors, which are not reliant on international trade and national export, I mean, may even do better. And some of them we have seen actually fare better in institutions. So I agree with you. We cannot generalize the China experience, but I think some of the lessons learned will be relevant. And the approach we as IFC are taking is we're not treating this as a crystal ball. We're saying every country we need to understand. So we are doing a survey in India right now, in Bangladesh right now, in Indonesia right now, in Vietnam right now. And we're talking to these SMEs to understand what their specific challenges are. And I think the regulation, the regulatory response, the financial sector response, the real sector response, and the fiscal and financial response has to be linked to the country. It cannot be generalized. Sorry, you're on mute, Nick.
We have one raised hand from Davina, so I already allow her to speak. Davina, can you hear us? Do you have the
Yes.
questions? Okay, do you have a question?
No, I actually did. I didn't. I don't know if something went wrong.
Okay. Okay, it's okay.
Yeah, sorry.
Okay, no worries. Okay. So I think you cover in most of it. Okay, one last question coming from me is on those interventions, because you group it into 6 pockets of intervention from the central bank. So if we can go back previous 2-3 slide, Tati. One, next, previous, one more. Okay, one more. No, further down. This one. So you mentioned about this 1, 2, 3, 4, 5, 6. So this 6 is basically, it's a generic kind of like intervention where it falls under fiscal, it falls under monetary, or it falls under, setting up a proper infrastructure for online transaction and those kind of things. So do you think that, this kind of responses coming from regulators or government, it's echoes the whole countries that that are facing with COVID-19 now?
Yeah, I think we've studied internally close to 10 to 15 markets. We are still collating this, and maybe we can have another session purely on that, which is purely on library of responses that's come through. But based on what we've learned so far, these are the main buckets of responses, and we are seeing central banks stepping in quite heavily, I think, in many of the countries in terms of giving the reliefs that are highlighting, as well as we are seeing some of the tax benefits. I think these are quick to do. So these are also, you saw the Turkey example. Disaster relief programs for small enterprises are not as prevalent. I think few have launched it, few have not launched it, because you have to have a very robust mechanism to manage it. So there are some loan categories in Turkey, for example, that they are looking at. Procurement payment delays, I think it's being done more in isolation by sectors and corporates. So I think, but conflict mediation and penalties and some of the payment delay are being, but again, it's not purely controlled by the legislation. It's more of a corporate practice. We are seeing not as much of it as we would like to. And the commercial bank support package for SME is now coming up. The issue is that many of the markets have just been hit by this COVID-19 in the last 1 month or so. So they have still going through. So we've started, just to conclude, based on our analysis with our clients, we felt there were 4 main areas of need, and we are conducting knowledge sharing sessions for our clients on those 4 areas. One, on understanding what is it that the SMEs need. So these researches that I mentioned to you, what is really needed by them, both from financial and non-financial standpoints, from capacity building standpoint and from access to finance standpoint. That's one. Secondly, we are also looking at stress testing. So many, and that's where again central banks are coming in as well, on how should the banks stress test in this environment. Can the models that have existed in Ebola and others, still hold, or they are different models for stress testing? So stress testing is, and linked to that is very thorough analysis of underserved segments when it comes to micro, small enterprises, doing a portfolio analysis of how are we looking at a 70% delinquency? Recently, there was a report on India that there was, fear of 70% SMEs going under if this lasts more than 3 months. So what kind of, risk analysis banks need to do? So that's within the risk area. The third area is more around digitization, on how now either digital solutions or digital partnerships are needed, because you don't have time to build new technology solutions right now.
Correct.
So a lot of where can I find the right fintech to support or technology solution to support my need? So how do you digitize in this environment and launch some digitized solutions? And of course, I think then a response plan on how you respond to some of the SME capacities that banks need to enhance. Because I feel SMEs are going to get the brunt of the issues that are coming through in COVID-19. So I think that's in summary what I'd like to highlight.
Thank you so much. I think we overshoot a bit, but just thank you so much. Thank you so much for the presentation. So I think allow me to conclude that for today's discussion, we have seen that supply chain finance is an innovative approach to meet the global MSME credit gap. One, secondly, the central bank and regulators play a pivotal role in developing and scaling up the supply chain finance to the market. And as supply chain finance also is not just a reverse factoring, as you mentioned. There are different portfolio that can be leveraged on, and fintech as well as digitalized data are transforming for a better supply chain finance services. And currently, in the presence of current pandemic of COVID-19, supply chain finance and also the role of regulators and government could be the conduit in mitigating the liquidity crisis for the among MSME. So I think with that, we can conclude on our discussion today. Thank you so much from Afi. We would like to, thank you and also the IFC team for the presentations, and hope that, we can, we can have more discussion further, especially on COVID-19. And then, what we can do is that we can give more views coming from the developing and also emerging market. Thank you so much.
No, thank you, Nick. I also want to quickly thank you and Tati for all the support. And I'd like to thank Afi as well for inviting us, for giving us this opportunity. And most of all, I'd like to thank all the participants, because I think I saw some fantastic, relevant, to the point questions. So I really enjoyed this session, and I look forward to our continued collaboration.
Thank you so much, and thank you to all the participants and the support given to Afi and also IFC for this discussion. Thank you so much.